and I will leave you to share your screen.
Okay, so hi everybody. My name is Isabella and I am from SeedLegals. And if you don't know what that is, that's not a problem. The kind of point of today is everything about getting investment ready and getting funded. And that seems to be the $1 million question, especially in recent times. So this webinar is kind of just going to take you through everything from the moment you create your idea and that honeymoon stage to actually making that idea investable through to getting funded, and then through to thinking, well, what do I do once that money is in my bank account, which is growth. So if we start from the beginning of you've created an idea and you pretty much think you're going to change the world, and that might have happened a month ago, it might have happened yesterday, but creating a company is really hard, right? And 10% of founders do split up. And especially in times like these, where investment isn't exactly on the forefront of everyone's mind and the pressure is on, a lot of companies do kind of fall through on that front. So what we always recommend is, as a basic, before you even think of moving forward, is do you have these key things in place? Do you have a founder's agreement in place? So what is a founder's agreement? Well, it's the really basic contract of what you and your co-founder do and what your obligations are to the company. So what are your responsibilities? And I think the thing that people forget that's even more important than the actual founder's agreement is what it puts in place, or what it should put in place, which is called share vesting. So what is share vesting? Share vesting is the agreement that, let's say you own 50% of the shares and your other co-founder also owns the other 50% of the shares. What happens if he leaves, right? Half of your company are ghost shares, they're uninvestable, right? They're not bringing in new clients, they're not bringing in new capital. And immediately, because half of your company is essentially silent, you become uninvestable. So share vesting is this agreement that you get your shares up front, but if you leave before a specific amount of time, which is normally about 3 years, that's the average amount we've seen based on the 10,000 companies we work with, then you have to give a percentage of those shares back, right? And the reason that you do this is twofold. One, I don't care if your co-founder is your brother, your best friend, your mother, your father, whoever, you should always prepare for when things are bad whilst things are really, really good. And these kind of clauses, because you don't know what will happen, someone might get sick, right? Someone might not be able to contribute to the business, yet they still have 50% of the shares. What you should do is give them an option to exit. So you're creating that certainty there. And more importantly, your investors don't know you and your co-founder. Why would they just invest in you if one of you could walk off with half the company with no kind of attribute to having to actually contribute to that company? So a founder's agreement incorporated with share vesting is the quintessential basis of all kind of companies. Now, the second point, which everyone seems to think is a little bit more complicated than it is your IP. So what is your IP, your intellectual property? It's not your cure to cancer or some game-changing manufacturing device. It is everything from your logo to your data, to your source code, to your design. So what does that mean? That means when your designer, right, or your web agency create your first website, when they create your logo and you pay them for it, you assume that you own those rights, right? Well, you don't. Unless there's a specific agreement in place that the company holds the rights to those things, you don't own them. And time again, I've seen, kind of very sketchy digital agencies use that lack of knowledge of founders. So let's say they create a website for you and you pay them for it. And then you go on to raise quite a lot of money. They could come back to you and say, actually, we want 3 times the amount of money to sign over the rights to you. Similarly, if it's someone within your company, right, like your head of digital marketing, and they've created designs, that work should be assigned to the company, not to the person. And again, why do we do this? Well, one, so you can own the rights to what constitutes your business and its image and whatever else you create. But two, your investors are going to want to know, like, were you smart enough to think about these things? Because once again, if they ask these questions, right, and you don't necessarily have the answers, or you haven't even thought about it, in their head, they're thinking, okay, what else have they not thought about? So as I said, kind of prepare for when things are bad whilst things are good, most importantly to protect the business, but also so you can create that professionalism with your founders, your investors. So the second point is SEIS and EIS advance assurance. Who knows what this is? I mean, obviously everybody's on mute, right? But SEIS and EIS advanced assurance, if you don't know what it is and you're going for your first round especially, you really should know what it is. And why is that? It's simply because 90% of all early stage investment is raised through SEIS and EIS advanced assurance funds. So what are they? Basically, HMRC wanted to incentivize investors to invest in risky ventures, aka startups, right? So what did they do? They created a tax scheme that allows your investors to claim a 50% tax break on 100 up to 150 grand invested into like a risky venture, or 30% tax break, depending on kind of what you give them. So you as a company can take on £150,000 of SEIS shares, meaning you can give those investors that are part of that 150 grand 50% tax break, or you can take up to £12 million, where you can give those investors that are part of that 12 million 30% tax break. So specifically now, right, why is SEIS important? Because the assets market, right, has crashed. The FTSE is down 30 to 40%. So investors are asking themselves one thing: where are they going to invest their money, right? Especially with the end of the tax year coming up on April 5th. Do they invest in assets? Do they invest in startups? Having that 50% tax break is a huge incentive for investors at the moment, specifically because of what the markets are looking like. So if you are going for your first round, I would highly recommend that you raise 150 grand with that 50% tax break. Like the 30% tax break, yeah, sure, it's great, but whether you're raising £1 over that initial 150 grand, or whether you're raising £1 million over that 150 grand, it's still 30%. Does that make sense? So a huge bargaining power, a bargaining chip is very much that 50% tax rate that you can give to your investors. And even outside of this time, as I said before, 90%, not 19, 90% of all early stage investment is funneled through this. So when your investor is picking to choose between you or your counterparty, well, if they're offering a tax incentive, so a rebate of 50% and you're not, it doesn't matter how good your idea is, it's most likely from a financial perspective, they will invest in them, okay? Cool, so you've protected yourself as a founder, you have SEIS and EIS advanced assurance, but actually on SEIS and EIS advanced assurance, a quick note on that is just what HMRC is looking for is for you to show that you are like supposedly risky, right? However, people should know that if you fall within the category of fintech and property, there are kind of exceptions there which may make you non-eligible for those tax breaks. At SeedLegals, we knew that that was a huge problem. Like the market standard approval rate was about 64%, which is nothing. And that was when accountants were doing it, not when startups were doing it. So we decided to kind of productize that, and through just automation, we reached something like a 98% approval rate, and we get companies approved within 2 weeks. And the reason I say that is, yeah, sure, it's a sales pitch, but more importantly, it's that if you get this wrong, or let's say in the next 2 weeks, you go on a Zoom call and you meet an investor, right? And you don't have your SEIS and EIS advanced assurance, it could lose you that investor. They could get cold feet in the time that you apply for it, because standard approval rates are 4 to 6 weeks, right? Plus, bear in mind, HMRC is dealing with furlough, it's dealing with the retention schemes. Like my guess that they are hugely overworked. So that will only go up. Whereas if you do it through us, because we have that connection and we do that due diligence, it's more likely you'll get approved faster. And the reason I say that is just don't wait. Like it's £250. Like you don't want to lose an investor because of it, if that makes sense. But if you are very confident, then do it yourself. I would just say, if you're going to go for funding, do it now. Like do it today, tomorrow. Because it's a really silly reason to not close investment. All right, cool. So you've got those two things in place, meaning you've protected yourself as a founder and you have got your SEIS advanced assurance. How do you value what you're worth? So I wouldn't normally say this, but because we're in a really weird time, you have to expect your valuations to drop. Whatever you come to, before I even say how, you have to expect that because the market is down, valuations are down. It's as simple as that. I'd like to say they're not connected, but they are. So this is really a time where you need to, one, show why your company is market leading in its niche and why it will survive this period and grow thereafter. And two, you're going to have to be ready to negotiate and potentially dilute yourself a little bit more than you usually would. And that's just because of the current climate. However, before we even get on to what your valuation is, like, how do you kind of get to that? Well, generally 4 conversations normally happen, which we thought were kind of crazy, but this is what it's like. And the first will be with your accountant, and he will ask you, what is your revenue this year? And you're probably going to say nothing, right? And then he'll say, well, that's fine. Okay. What is your expected revenue for next year? And especially in these times, you're probably going to say nothing. No, actually, we're going to lose money. And he's most likely going to say your revenue, your valuation is 0. Another thing people do is go on to TechCrunch and look at the American valuations. Yeah, if you're going to take an American valuation of a company of your type and size, take about 3 zeros off the end. American valuations just don't apply to the UK at any point, particularly not now. Then you have UKTN, which allows you to see companies of your type and size, but it only really shows what they raised, not what their valuation was. So, it's helpful, but not determinative. And then you could say, well, fine, I'll just create an Excel spreadsheet. I'm going to put in my burn rate. I'm going to look at what my prediction should be, what our revenue will be. And again, like, kind of investors take that with a pinch of salt. So we work with 10,000 companies, right? And we have data on all of them, and we've had that for 3 years. And what we saw was this. So if you look at this graph, if you look at the horizontal line, that's the amount of complete total equity founders gave away per funding round in total to all of their investors together. And the vertical line is the number of funding rounds they went through. So what we found was, on average, founders were giving away 15% equity per round. Okay, so what does that mean? Why am I talking about how much equity you gave away per round? Well, there's 2 things that you know now, right? How much equity should I be giving away? And the second, how much money do I need to get to that 6 to 12 to 18 month benchmark? So right now, if you're looking at yourself thinking, okay, it's tough times, we're probably not going to make revenue, how much money do I need? You know that, right? You know how much you need to pay your employees. You know how much your office space costs. You know that you maybe need to hire a web designer or a developer or whatever. You know how much your web domain costs, like how much you're going to spend on Google Ads if you're there, like, these things. And then you have to factor into that, okay, how long am I going to take to fundraise? And again, if it was going to be 3 months, then extend that to 6 months, right? So those stats. And with those 2 numbers, you can ask yourself, okay, so I'm giving away 15% and I need 100 grand to get to next March. Well, what is my valuation? Well, really, you would just do 100 times 5, which would be your pre-money valuation of 500 grand, plus the money that you'd be getting in. And kind of, if you do what is 100 grand of a 600 grand valuation, post money, well, it will come on average to about 15%. And although this isn't kind of the Bible, it is something that is a metric that is proven to kind of show your investors as to like why this makes sense. And it also generally stops you, as long as the amount of money you've raised is right, from overvaluing yourself. But why again, like, why should you only be giving away 15%? Well, everybody knows that founders always make this mistake of judging their company by their first funding round, right? oh, we're only as much as we raise. And it's not true. Your business is worth a lot more than its first funding round, isn't it? Like, let's say you give away 30% for your first 100 grand. Okay, that's your first funding round. And let's say for your second funding round, you raise 500 grand and you give away another 30%. Okay, cool. You've given away 60% of your company and you have 600 grand in the bank. Well done. You've raised 2 rounds. You guys must be doing super well. Investors like you. Fantastic. Yeah, you're uninvestable from that point onward. Do you know why? Because you've raised really no money and you have 40% of your company left. Like, any VC, any larger investor, anybody else who would want to go in for that growth, there's not enough equity left. You also are a minority shareholder in your own company. So VC will think, oh, you don't have enough skin in the game. A bank will think, no. So whereas if you give away 15%, right, and you do that for 3 rounds, you're at your 3rd round, so probably pre-Series A, and you've only given away 45% of your company, which puts you in a really good position. And the thing is, like, this is not my opinion. This is the data speaking for itself. All the companies on this graph, right, that founded this graph, which is not a sample of 2, it's a sample of like 10,000. These are all companies that went on to raise again and again. These are not companies that went on to raise and then fail. Bear in mind, 50% of startups do fail. So just really bear that in mind when you're creating your valuation. And yeah, just kind of focus on that. So once you've come to your valuation, and again, expect them to take a bit of a knock at the moment, but what valuation should you be talking to your investors with? So what is a pre-money valuation? Pre-money valuation, if we go back to the example, is that number that you've created, right? Like, we said we want to raise 100 grand. Our pre-money valuation is 500 grand because, you know, with the money from the investors, the point is that it's this number that you've created, and your post-money valuation is that number plus the investment that you get. So you wanted to raise 100 grand, your pre-money valuation is 500 grand, your post-money valuation is 600 grand. It's just simple kind of maths. So why do we talk to investors about a pre-money valuation? It's really quite simple. Let's say you email all of your investors next week. You know, you finally got them on, right? And yeah, hi, ladies and gentlemen, we are going ahead with the 600 grand valuation, looking forward to closing this round, blah, 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 blah. And then the market's taken another turn and one of your investors comes back and says, I'm really sorry, like, I have to pull out, and you lose 50 grand, okay? You now have to email all of your investors and say, hi, ladies and gentlemen, I'm really sorry, but the valuation is now changed to £550,000. And immediately in your investor's mind, it's like, why has the valuation gone down? Why has the situation changed? Like, they haven't even raised yet. That's crazy. Did they get the maths wrong? And it's this thing of, you start creating that subconscious doubt. And the thing is that your valuation didn't change. The amount of money you raised changed, and there's a difference. So don't put your valuation as a moving target. Don't make it contingent on how much you actually end up raising. Set your valuation as your pre-money valuation, because that is a fixed number. And if there's one thing investors don't tolerate, it is inconsistency, especially at the early stage. Okay, so why equity, and should you take on equity? Well, I always kind of like to start off, okay, why equity? Well, for me, most importantly, and kind of in our company, is that when you take on equity, you're not just taking on your investors as capital, right? They're not banks. Like, there's a reason you raise with angels. You're also taking them on as smart investors, meaning you're taking them on for their expertise. Like, angel investors do this, some as part-time, but most as a career path, and they've been through a lot of companies and they have a lot of expertise that could help you, right? And in the same way that you're doing the due diligence so you look good to your investors, make sure you're doing the due diligence on your investors. Like, if they're bringing up weird stuff like, yeah, we want to take away 30% of your company for 50 grand, that in your head should not say, oh, like, it should say he's a stupid investor, because if he wants for the good of the company, he knows he can't take that amount of equity without screwing you guys over, right? So little bits and pieces like that. So equity, because you can take on great investment with great investors and have their expertise. And then fact number 2 is like, well, you're unlikely to be able to raise the amount you want from an institutional investor like a bank without probably sacrificing your arm, your leg, your house, right? Which I don't think you'd probably want to do right now. And then last bit is obviously there's no kind of liability with equity. I mean, obviously you don't want to screw over your investors, but it's kind of confined to the business. But the question now, which is kind of more important, is do you need to give away equity? And I love to give this example of buffer. So back in the day, social media scheduling was not a thing. If you wanted to post in something for Twitter that would go out to an American audience, you'd have to wake up at stupid hours and set your alarm at like, you know, whatever time, like 2 a.m. to be able to get them in the early evening, right? And so these two founders, one techie and one kind of more business guy, created this idea for buffer. And really early on, they got a lot of investment interest, one being 100 grand for 30% of the company. And they were thinking, this is great. We can create this product. We can create that product. We can expand here. We can spend on ads, whatever. But then the tech guy was like, no, I don't really want to take on this money till I know that the product works, right? And so he created a landing page kind of outlining like who they were, and there's a bit of a sign up thing, and then people would get an email and they would basically say, hey, like, yeah, this is what we do, but actually we're not ready yet, so come back. And then the second, and they got lots of signups. And then the second landing page that they did was a pricing landing page where people would go on and sign up, and then they get a list of prices, and people started paying. And then as such, they started developing revenue, and they were developing the actual products, whatever. The point is that they never gave away equity till very, 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 very later on. And they didn't need to. And they actually spent their time on stuff that made the product work, as opposed to having money that they didn't need, spending on stuff that they didn't actually help. So my thing is that don't see funding as validation, because it's not. If you don't need to raise, don't. In this quarantine time, you can sit at home and code, or learn how to code and create an MVP, or just create a landing page, or like really basic stuff to generate interest, and do that. Because validation more than ever is so important, not just for your investors, but also for you. So only raise equity if you need to. Now, if you're a company that's turning revenue, if you have revenue, you have cash reserves, why do you need equity to grow? Like, you should only really be giving away equity and taking on more investment if you don't have enough money to grow without burning your cash reserves. Does that make sense? So again, like with this whole thing of like, 100 million valuations and I'm raising however much, it doesn't really matter. Point is like, does the business work? And if it does work, like, do you have enough revenue to grow on your own? Like, why would you dilute yourself if you don't need to, right? So why equity, and like when, and really when I've just gone through, really when you need to. But let's say you are going to raise investment and you need it. So when you're speaking to investors, well, where do you find them, right? Like, that's the question. Where do we find investors? When I joined SeedLegals, Anthony Rose, who is the CEO and created BBC iPlayer, and sold a company to Amazon and whatever, he's done a lot. I was thinking, okay, Anthony, this is great. Tell me, like, where do you find your investors? Like, what's the trick? And he's like, Bella, I use the strongest tool of all. And I was like, really? Well, tell me, what is it? And he goes, LinkedIn. What? What? And it's true. I mean, if you go on Anthony's profile, he has quite a few thousand followers and subscribers. And he said, well, if I send a message out to all of them and like 1% get back to me, that's quite a few more people that know about the product that didn't know about the product before. And I was like, okay, but that's not investment. And he's like, yeah, well, actually, especially angel investors are the people you know, but you didn't know, And I was like, okay, and it's true. So let's take a hypothetical of SeedLegals. Legal tech company looking to change funding rounds, have SEIS and EIS advanced assurance. Those are the magic words. Looking to raise, let's say, 300 grand. And you send this blurb out to everybody in your LinkedIn kind of portfolio. And what tends to happen is you get response, you get advice, you get criticism, you get knowledge of your competitors, and you might actually get some investment interest. And when that comes through, this is the thing. You need 2 pitch decks. One being the business, like who are we, what do we do, what is our why, what is our how, right? And the other being the more serious deck, which is the financial deck. With that your secret sauce of your business model, your revenue models, why the product works, like if it's something to do with manufacturing, like what is the tick that you guys have. So why should you separate those 2? Well, the first is the bad situation, which is often that VCs drag along a lot of companies saying, yeah, we love what you do, we'll send you out a term sheet, and then it comes to signing the term sheet and they drop out, and then you see them invest in a competitor about a month later. And the reason that they do this is they're doing due diligence on your company to see whether the company they're investing in can get better or has all of those things. And so if you give them everything up front, well, you're kind of screwing yourself over, to be honest, because you haven't made them sign an NDA. There's nothing illegal about that, not really. And the second point is, which is probably more debilitating, is that where you are sending this to investors who are great investors and want and really like the business, well, if they're a good investor, all they're going to be thinking is, who else have they sent this to, right? Who else has this information? Like, why were they stupid enough to send this to me and I haven't even signed anything? And I would say, don't be crazy with NDAs. Like, you don't want to be this person just throwing them around, like, sign my NDA. But you need to be aware that you're giving information about your company, and really there's no legal liability there. So 1, protect yourself, and 2, don't look stupid for other investors. Whereas if you could just show the business, and then if someone wants a serious conversation, then give them that more specific debt. And again, this builds on this question of, how do you look professional to your investors? This is how you look professional. It's all smoke and mirrors, you know, like, have you done this before? No. Can you look like you've done this before? Of course you can. Okay, on that note, when your investors come to you, they're going to ask you, okay, if I give you, 100 grand for 0.8% of the company, what's my equity dilution? Cap tables. So cap tables are representations of who owns what in the company, what kind of shares, whatever. Okay, 30% of cap tables are wrong. 30, like 1 in 3. And that's at the early stage. That's when things are easy. And the reason is that people get the maths wrong a lot. Like, you think in your head, okay, we have this many shares and like, this is the price per share. Surely, if we give them this amount, that's fine. It generally isn't. And there is no reason to get that wrong, simply because there are so many companies that have automated cap table creation. So there's us, SeedLegals, where you get it for free. There's also Cap Desk, like whoever you want to choose, I don't really care. Just use them, because often you calculate your cap table wrong and it really pisses off investors, because it's a bit like, well, if you can't get the maths now right, how are you going to get it right when we go through an actual funding round, right? So please get it right. There's kind of no reason for that not to be right. But also kind of on cap tables, before I move forward, keep it simple. You kind of see people going in thinking, I'm so important, I'm going to protect myself as a founder, I'm going to create loads of share classes and loads of share types with different rights and so on and so forth. And actually, like, really what you're doing is creating loads of potential legal liabilities and possibly making yourself uninvestable, if I'm being honest. Often VCs don't invest in companies because their cap table is too complicated and they have to get so many approvals from so many investors, and there are so many board meetings that they really are just put off because it takes so much time, it kills the business. Keep things simple, like really keep things simple. The amount of founders I speak to day to day that haven't even raised yet, and they're like, yeah, I'm in this law thing because I signed this thing, and it doesn't make sense. So avoid it, because your company might not get off the ground before it's even actually taken off. Okay, cool. So great, not to be depressing, but you have protected yourself as a founder, you have SEIS and EIS advance assurance, you have a valuation, hopefully a good one, and you found investors, and now you're at this crazy point, which is the funding round. So we have other webinars, which I will send through to Daniel and to Alex on negotiating a term sheet, and different webinars that deep dive into everything I'm mentioning, because I know I'm mentioning a lot. So I'm not going to take you through every single legal of a term sheet, but if you are in negotiation of a term sheet or you do want that, just come back to me or to them and I'll send something through. But for now, just the kind of big overview points is, as I said, keep your share classes really simple. A ordinary shares and B ordinary shares, same voting rights, same dividends. Also, if an investor comes back and says, well, no, these are risky times, I want a liquidation preference, I want to make sure if the company goes under, I get paid. Well, just say, fine, that's okay. But you are not eligible for your SEIS and EIS advanced insurance. So remember that 50% tax break I mentioned? Well, if they have a share that has that kind of payout, they're not eligible, simply because, well, fine, if you're going to get a payout, it's not a very risky investment, is it? And you will see very quickly that they look pretty stupid because obviously they prefer the 50% tax break, right? So that's a quick win if someone comes back to you asking for silly share classes. Pre-emption right. So pre-emption is basically something that always comes up, and it's completely fine. But it's basically this agreement that, let's say an investor owns 5% of your business, right? And then you go through a funding round and you've obviously diluted him because you created more shares to your new investors. Well, this basically gives him the right to buy back shares so that he can maintain his equity, and that's okay. The only time I wouldn't agree to a preemption right is if someone owns like 45% of your company, and then let's say, you know, at Series A you have a VC investing. Well, it's really hard for a VC to invest if someone else already owns 45% of the company and they can't really buy those shares because of that preemption right. But generally, as a rule of thumb, it's okay. What you shouldn't be agreeing to is anti-dilution right. So anti-dilution is basically this agreement that if someone owns 50%, 5% of your shares, every time you go through a funding round, you as a company top up those shares. You pay for that. Can you imagine? You're literally just bleeding cash. And if you think about how much more expensive your shares will get, that person is making a lot of money. Never agree to that. It is a debilitating legal clause. And anybody asking for it, I just don't think is a great person, to be honest. Corporate governance, so stuff like, okay, how do we run the business? Like, how often should we have board meetings? Who should be on the board? Like, so I think everybody thinks, I want to be transparent. I want to be really in it. I'm going to get things right, and have like a board meeting every month. I would advise against that, mainly because board meetings take a lot of time. Writing up the minutes takes a lot of time. Getting the data together, like, also you waste other people's time. Like, you're in the stage where you are moving so quickly. Things are changing constantly. You don't really have the time to spend like however much part of your month preparing for that meeting that actually is not saying much because things are changing so quickly. Your best bet is do one every quarter, you know, do 2 a year. Like, there's no point. Kind of really think of that quality over quantity, I would say, and time. Don't make things overly complicated for no reason. And that goes again with, in terms of picking, like, a lot of investors will say, I want an investor director. But if you have an investor director, every decision you make, you have to pass by that person. So if you think about how many things you do in a day, or if you're taking on a new employee, or if you're in a growth stage, you really want to email that person every single time you want to make a decision. And if an investor is pushing for it, just say, okay, fine, that's okay. But just expect a fuck ton of emails from me. Do you know what I mean? Like, just expect me to be your main point of contact. Like, and again, it's this thing of like, keep it simple. Yeah, sure, down the line it makes sense because things are like more regimented. You have more oversight on the company. Like, you're becoming, I suppose, like, more systematic, and that does make sense. But at the moment, you're moving so quickly. Like, don't like dig yourself down with stuff that corporate people do. So even, and this is not an opinion. Like, I will show you the data. Let's look at it. For a raise, right, that's up to 150K. You know, a third of founders suggest to have an investor director. Only 40% actually do. Whereas if you look at companies raising over 800 grand, where your things are a little bit more serious, okay, over 90% have an investor director. And you can see that shift, and it does make sense because at that point you should have that external voice kind of approving stuff. Similar with founder salaries. It's this kind of same thing. If you're having an issue with an investor and he's like, well, no, these are tough times, we're not paying you. Well, if your valuation is sub 2 million, your average payout as a founder is 20 grand. If vice versa, if it's, you know, 10 million valuation, you're up to the kind of 120s. And that's just data. based on a lot of companies on a lot of time. So again, like if you're having difficulties, just show them that. Similarly with share vesting, a lot of investors will try and put you onto a very long share vesting schedule. Most people are on 3 years, so you have to stay with the company for 3 years to get your shares. And most founders have share vesting. So again, this is just the basic data there. And this is just salaries. Where you're kind of sub 150K fundraise, half have a salary. Once you're above that, most people have a salary. Again, this is just data for you to show what the market, basically, this is not to tell you what to do. This is so you know what the market standard is, and you can decide how far is what we are agreeing to from the market standard, you know, and that's kind of the point of this data. Warranties will be in your term sheet. So warranties are basically like disclosure. Is there a chip in the office table? Do one of the computers not work? Like, is the office leaking? Like all these kind of things. Make sure you disclose them adequately, just because it saves you legal liability, and you should have that transparency. Also, I realized I skipped a huge step. How do like investor negotiations work? Well, simply like you will be in negotiating over one document, which is called a term sheet, which is kind of the short version of what will be legally binding. And the reason that we do all of our negotiation through that is because it's short. So that's the bulk of the negotiation. Now, it is not legally binding. However, generally, if an investor signs up to that, they will most likely sign up to the deal. What is legally binding is the longer version doc, which is called the shareholders agreement, in line with articles of association. So I don't know if you've noticed, but if you sign up your company on Companies House automatically give you articles of association, which is basically governance, like how do you run the business. So when you go through a funding round, those get amended alongside your shareholders agreement. So just have those kind of three big thoughts in your head as to how this all works. But again, we have a webinar on depths and dives of actual term sheet negotiations. In terms of, I'm like throwing all this legal jargon at you, and I'm just expecting you to know how to then use that. Well, that's kind of what SeedLegals is for. And again, this could be an upsell, it could not be. The point that I want to show you is that what we, in our head, we were a bit like, these agreements are the same every single time you go through them. Like whether you're raising 10 million or raising 150 grand, they are the same pretty much. So we were a bit like, okay, let's just take away all the words. Like, what are you actually agreeing to? So when you go through us, if you are going to enter an investor negotiation, lead with your term sheet. In the same way that you're negotiating a salary, don't let your employer set the first number. You set the first number. Similarly here, you set the mark of what the term sheet should look like for two reasons. One, to look like you know what the hell is going on and this is not your first rodeo. And two, so that you have some bargaining power, basically. And so you go through this and you answer the questions and you understand what you're agreeing to. And then what we do is we generate all the legal jargon. So when you look at this document, rather than seeing this and thinking, well, what the hell is in it? You can just jump back and think, okay, actually, no, I know exactly what I'm agreeing to. And that basically allows you not to get screwed over, essentially. And that's kind of point of what we do as a company. And also just for you guys to learn and understand, like, it is your duty as a founder to understand the legals. Like, you shouldn't say, oh, I didn't study law. No, you're in the 21st century. Like, you can learn it if you want to. The resources are there and they're really, really simple. So in terms of raising now, if I'm being honest, if you have investors lined up and it's not your target raise, so you haven't got enough that you wanted, close your round, like secure that investment. You are better off with some money than no money, to be honest. And the reason I say that is because that does not mean you then can't fundraise again. We developed two things which I think will be really, really useful now, especially with funding being so all over the place. And one is for you to raise ahead of your round, and the second is for you to be able to top up after you've closed a round. So what do I mean there? Well, I kind of lied to you all before, and I'm sorry, but essentially funding has changed dramatically. So in 2018, yeah, people were raising on average once or twice a year and giving away 15% equity. In 2019, after we launched those two products, funding changed completely. And why? Because you can now raise continuously. There is no longer this boom and bust cycle of I have to raise every 6 to 18 months. So what did we innovate? Well, there's this thing that HMRC released called an advanced subscription agreement. Okay, that allows you to take in money ahead of your round, right? And then determine the valuation of the shares later. So let me give you an example. You meet an investor, he loves what you do, but you're not raising right now. Normally you'd have to say, sorry, come back in 3 months when we're raising. Now you could just say, great, give me your email, I'll sign you on. He gives you the investment of maybe 50 to 100 grand. You give him the equity, but the value of that equity, how much the shares are worth, only gets determined when you go through an actual funding round, okay? So it's kind of like a convertible loan note, right? Except it's not debt, it's equity. And it's this agreement that your investor will agree to because one, he believes in the company, and two, he'll probably get discounts on the shares. Now, the reason that's important in today's climate is because I think people will struggle to get a lot of investors together, but you can take on money saying we will raise in 6 months in December when things quiet down, basically. So really use an advanced subscription agreement if you can, or a seed fast, because it allows you to kind of have that cash flow and then go through a better round later on. Similarly, if you have a round now, but you don't have enough investors, close your round. And then use what we created, which is called an instant investment, to top up that round. And what that agreement is that you as a company, to a certain amount, so to your target raise of, let's say, 300 grand, and for a certain amount of time, which is normally about 6 to 8 months, you can top up your round and take on extra investment after you've closed your round. So what does that mean? We've closed our round. Everybody is signed. You've issued like share certificates to your investors. Great. You meet an investor over a Zoom call. Fantastic. He's like, I love what you do. You're like, normally you'd say, I'm really sorry, we closed our round, you can't join. Now you can say, great, give me your email, I will sign you on. He signs on to the same deal terms at the same share price or a higher share price. And the reason that there's no negotiation whatsoever is because you have closed your funding round. You cannot change the legals. You cannot downvalue your share price, okay? All you can do is sign him on, take on his money, and give him the equity. And that's great because you can do that when and where you want to. So if you've closed your round now and you don't have enough money, don't worry. You can take on new investors if you implement that clause into your shareholders agreement. Again, like, I know this is a bit complicated. If you don't understand, that's okay. Come back to me after. All you need to know is you can raise ahead of your round, you can go through a round, and then you can top up that round, okay? And the data speaks for itself. In 2019, founders were raising on average 4 to 5 times a year. That's double the amount they were the year before, and they were giving away half the amount of equity per round, meaning they were raising small amounts when and where they needed to, as opposed to going through a large round once or twice a year. So I'm at my last point, last 2 points, which is, once you get that money in the bank, what the hell do you do with it, right? Like, what do you do? Well, your really big thing should be growth. And the best way to grow is really difficult because you want to take on great employees, but you don't have the financials to do it. Well, the way that you offset kind of what you can't pay them is through giving them options. Options are shares, essentially. Options are the agreement that your employees have the right to buy shares in the company after a vesting period. So what does that mean is that if they stay within the company for 3 months, they have the right to buy shares and exercise those shares after those 3 years. And why would you give them options? Well, you give them options because it incentivizes them to work to grow the company. And options, particularly now, also they get a huge tax break. That's the biggest thing. Like, the reason HMRC implemented this is because giving shares to people is really expensive. Like, don't do that big mistake where you go through a funding round and then you give shares to your employees. Like, if you do that, they incur a huge capital gains liability, and so does the company. Give them options. That's why it's there. Again, if you don't understand what options are, that's okay. We have a webinar that kind of deep dives on what those are. Point is, and this is my penultimate point, is that now particularly options are so important. If you are struggling with your employees to pay them and your runway is thinning out, cut their salaries, but give them options. I know that sounds crazy, but rather than make someone redundant, or you can put them on furlough. That's also a point. But for the ones that you need to keep on, but you can't afford to pay, give them options. That's like kind of a really nice medium. Now, the last point that we have is advisors. This is not kind of relevant at the moment, but I always say kind of talk is cheap and execution is expensive. However, if you do have an advisor and he's great and you do want to give him equity, these are the stats on that. If your valuation is sub 1.5 million, the mean equity is 2.2%. If your valuation is over 1.5 million, it's 1.6%. And again, just don't do that thing where people give an advisor 5% of their company and that's actually worth about 50 grand, and you could have hired a full stack developer for at least half a year on that. Do you know what I mean? So really think in monetary values where you're putting that money. However, I know this was a lot. I'm from SeedLegals. We are kind of here, or we're the largest closure funding rounds in the UK, and our point is actually to help founders and startups not get caught in those details. Also, in terms of anybody has questions on recent government grants or what the fundraising landscape is looking like now, we are kind of the market leader on the data there. Like literally, if you type in a further agreement, SeedLegals will come up. Point that I'm trying to make is that we are here to help. So if you have questions or you're stuck, you're struggling, kind of come our way and we are more than happy to help. And yeah, and if you want to email me, this is my email. And that's it from me. So Daniel, if you want to open the floor up to questions or whatever you want to do, and I'm happy to help.
Lovely, that's perfect. What I'm going to do, guys, Edgaris had a couple of questions, so I'm just going to unmute him and let him ask the first question. If you've got any questions, can you just put in the chat that you want to ask a question, and then I'll unmute you. So Edgaris, you should now be unmuted.
Can you hear me? 111.
We can hear you.
Yeah, okay. So basically I would have a few following questions. So the first one, as soon as it comes to business operations, which bank is the best fees-wise?
Business operations, I actually probably couldn't tell you, just because we're not really allowed to add preferences there. They're all very different. I don't want to give you the wrong answer, so we don't cover that at all.
Okay, let's say I would have like 6 banks, and which one most likely you would prefer? Let's say it would be Tarling Bank, Barclays.
We would normally take Barclays. Yeah, that's the bank we use. And that's the bank, if I had to recommend not as part of SeedLegals, I would probably recommend Barclays. I think they have the best SME community and the best kind of perks for companies that are raising or have their business operations.
And what about counting up? As I know, it's also a new bank, which do all the accounting part for the businesses.
I've never used them. I think with accounting, like as long as it's automated and there are no mistakes, like a lot of them do very similar things. It just depends on what their cost is like. I think that's the bottom line is like, are you getting the quality, and then what's the cost margin there? So again, like it's not really within our expertise. We kind of focus more on the legals rather than the actual business.
Yeah, okay, got it. Thanks.
Sorry about that.
A quick one before I go to the next question. Are we going to be able to send slides out?
Yeah, 100%. I'll send the slides and I'll send the links to other webinars we're running or recordings of ones we've ran that deep dive into different things. Again, Edgar, as before, you probably watch them. Those will very much more be about like actually fundraising or runways rather than business operations and kind of that side of stuff. But
cool. Yeah. And as I said right at the start, we have recorded this particular session, so that will be available as well. I'm going to unmute Alex next for the next question.
Yeah.
Alex.
Edgaris, just in addition to that, you do well to, if you're looking at banks, look at the actual banks that have the FSCS scheme involved into them, because, for example, Tide doesn't. And while there are levels of protection in there, they don't all have that. And a lot have, like, for example, Starling's got a better way of accessing through directors than Tide does as well. I use Tide for a few different accounts, but like they've all got different benefits based on director access and protection for financial services compensation scheme and things like that as well. Like accounting, you can easily just set up 0. That's what we use. So, and it's quite good and pretty cheap. So yeah. But anyway, just in addition, so because I know Isabella.
So thank you, Alex.
That's all right. Yeah, so I had a question about option schemes. So option schemes tend to generally only make sense when you've got a certain number of employees, and you know they are still, I know they're cheaper obviously with you guys, but they still cost money, quite a lot of it. So what would you say in terms of incentives beyond, you know, the option schemes, and when do you make that decision?
So with options, the reason I say get them in is kind of money well spent is because if you start implementing option schemes after you've raised 1 or 2 rounds, investors get a little bit annoyed because it dilutes them so much. And you're kind of better off. Also, put it this way, I would really think about it a long-term investment. If you don't have an option scheme, right, after maybe your first or second funding round, the question that I think would initially come through my head as an investor is like, what are your prospects for growth, right? It's a bit like, why is that not even there? Like, have you not prepared the infrastructure for growing in the future? So yeah, sure, the cost is up front, but if you're thinking like it's $1,000 a year, it's $1,000 to, for example, set up an option scheme, and it's $1,000 a year to update your valuation, that in reflect of like what kind of investor interest it could generate, and also what kind of employees you could attract, the cost offsets itself basically. But in terms of when you should really be thinking about that, well, basically I really think when you start generating some sort of revenue and your team is growing past maybe 10 to 15 people, because if you're at that stage and you're able to hire that many people, my guess is you're possibly strong enough to raise again, right? And you have a better value proposition for your investors. And then my guess is if you're going to raise, then you'll have the money to pay for something like that and put in that infrastructure. So that's at that point. But obviously, if you're at ideation, like there's no point spending that money and putting in an option scheme, if that helps.
Alex? Oh, he's muted himself again. Don't worry.
But we have an EMI option scheme specific webinar, which Matthew runs. So I'll send that your way, Alex, just on the off cuff so you can listen to that.
I'm next going to go to Faris for the next question. Faris, away you go.
Thank you very much for the presentation. Very informative. So I've got two questions, if I may. The first is, what is the exact role of incubators or accelerators in terms of raising money? And the
go ahead.
You wanna go one by one, or should I ask both?
Sure. Like just because I have a really bad short-term memory.
Okay, so go ahead with the first one. Thank you.
Okay, so with accelerators and incubators, the ideal sell is entrepreneurial capital, which is like knowledge that you wouldn't have otherwise. So a lot of founders are very good at what they do, but they don't necessarily, and this is not everybody, but most don't necessarily know, you know, the legals or the business or the growth prospects or whatever. And it's about rounding those people off. Now, the second point is the investor community. So good accelerators have good investor networks. So when they run that demo day, there is a guarantee that they will be introducing you to the right investors. And when you're in a particular sector, right, health tech, logistics, fintech, edutech, whatever, it's really important that you are connected with the right investors in that niche. Having said that, and it's great, and good accelerators are good, like they're great because you have a reputation for even getting into them, like going to a good school. However, there are a lot of shit accelerators, and you have to remember that accelerators are taking on quite a lot of equity. Like a lot of accelerators take like 6% upwards, right, which is a lot. And they often have the right to buy into your next round. So there are a lot of shit accelerators as well. And that's the tricky thing. It's knowing and applying to the right ones, because a lot you'll spend 6 months there and not have learned that much and not have that many investor connections. So that's like their key strength, but also that's their only strength. So if you're not getting that, then you're wasting your time and you're wasting your equity.
And what was the second question? Where have I maybe he's muted himself. I'll just unmute. Hang on a sec.
Okay. So will the term sheets differ if it was a UK investor that would like to invest outside of UK, or the same exact term sheets would still apply?
So,
and what do you think is the appetite of English investors to go outside the kingdom?
So term sheets develop to change per jurisdiction. They're not like the terms are very similar, but the layout and the legalities of how a funding round closes is very different. In France, you need like a third party called a notaire. In Germany, it's very complicated. So you cannot take a term sheet from the UK and just replicate it and expect that to be legally binding somewhere else. However, you can learn from the terms. Now, the terms that do tend to be the same or very, very similar. So that's the crossover there. Now, in terms of a UK investor investing in another company abroad, again, like the thing is with UK incorporated companies, angel investors have really good tax breaks. They might not get those tax breaks if they invest in a company abroad. Also, the difficulty is that operating on a different legal basis means the actual understanding of the term sheet is very different, and investors don't like uncertainty and they don't know waters that they don't know. So if you're investing with them on a term sheet that's not British, it's a little bit difficult. However, and this is not an upsell, but it is something that's changing, is that we recently launched in France, for example, where we've automated that kind of mediation. So an English investor could look at a British term sheet, send it to a French company, and a French version of the term sheet with all the necessary French legals and the third-party requirements is automatically done. And what we're kind of going for there is that in the same way that you have TransferWise as borderless banking, SeedLegals has borderless legals. Now, we're only in France, but down the line, hopefully that question and my answer will be very different, where any investor across Europe can invest in any company with no issue at all. Does that answer your question though, overall? Like, essentially the answer is no. You shouldn't, like, generally it doesn't work, but it's a potential in the future.
Just unmute again so you can.
Just perfect answer. Thank you so much. Thank you.
Awesome. Thank you. So the next question comes from Liam. So Liam, I'm going to unmute you now.
Cool. Hi. Yeah, so I was just going to ask about SEIS and EIS advanced assurance. Like, what's the like typical timeframes if I were to try and get that independently versus using someone like SeedLegals, and what was like the difference in cost? Like, how much does it cost if you just go through HMRC or go straight to HMRC?
Yeah, so the average time frame pre quarantine and pre like furlough and whatever was 4 to 6 weeks.
4 to 6 was that, sorry?
Yeah, 4 to 6. If an accountant was doing it or if you were doing it. That's not the case anymore. HMRC is under the press massively at the moment because they're dealing with setting up that new furlough platform and taking in all the inquiries, and you can imagine the amount of calls that they're getting, and tax, and it also is the end of the tax year, so everyone will be sending in their SEIS and EIS. So I would say you're looking at minimum 8 weeks, to be honest, which is crazy, but that's kind of where it is. The cost with HMRC is like nothing, more or less. With us, it's $250, and with an accountant, it's like at least $1,000 or more. I've heard quotes of $3,000. It kind of pains me. I don't really know why, but anyway. I think the kind of difference is if you want to do it yourself, it's doable. It's not doable, 100%. Except if you sit within the realm of like fintech or property or oil and gas or infrastructure, be very careful because they do sit within the realm of exception, and you could lose an approval that you actually probably could have gotten. And number two is if you don't get approved, HMRC don't like looking at applications again. So I would just say be really like sure if you are going to do it that you will take the time to do it properly. Because not getting advanced assurance is really debilitating in early stages. And then, yeah, but there are loads of articles that we've written, if you do want to do it alone, that either email me and I'll send them to you, or go on our website, that are really good just for understanding like the point of SEIS and EIS and how to best approach it.
Yeah, okay, yeah, no, that sounds great, thanks. I was going to ask as well, I just missed something when you were talking about term sheets. You were saying never agree to a something. I can't remember what.
Anti-dilution.
Anti-dilution. Okay.
Gotcha. It's basically like whenever someone owns shares, anytime you go through a round. So when you go through a round, you create more shares and you reduce because you've created more share, you've diluted that person essentially. Anti-dilution is a right that crazy people agree to, because every time you go through a round, you have to top up that person's share so that they maintain that amount of equity. So if they own 5% and then that 5% becomes like 1.5%, you pay back that remaining 3.5%. And as companies get bigger and bigger, if you think of like maybe Netflix's share price now, which sits at £380, and let's say someone owned 5% back in the day, you are bleeding so much money, it's like not even funny. So that's kind of a term, unless you're dealing with a VC or a very large investor, like you should never agree to, basically, especially at this stage.
Gotcha. Cool. Thanks a lot.
All right.
Awesome. And then the next one then is from Olga. So I'll just unmute you now, Olga.
Thank you. Hello, Isabella. I would like to ask you if you can give me some advice who I can contact to help me with the terms and conditions in the website and also the attorney form.
Attorney form, I don't know. I'm really sorry. Is that a US? What kind of jurisdiction? Is this in the UK or?
Yeah, it's in UK. Like I can do in your behalf, for example, to ask for the compensation from the airline.
Right. Okay. Attorney forms, I don't know how. If you drop me an email, I can try and ask internally, because we have a legal team and an SEIS team, and I kind of run everything external, but I don't want to give you the wrong advice. So do drop me a line and I'll find that out for you. And then your first question was terms and conditions. Terms and conditions, we were about to launch terms and conditions and companies policies. I don't know if that was put on the back pedal. If it wasn't, we have them. But if it was, then basically most terms and conditions don't really change. What kind of stage are you at? Like, where is your company at the moment?
So actually, I haven't already started. So I just finished the website and I would like to start, but I can't start without terms and conditions and this.
Yeah, so kind of at your stage, if we haven't launched ours, there's a big mistake you see all the time is people telling lawyers I used to know and work with, saying, oh, pay me $3,000 and I'll give you terms and conditions. And this is terms and conditions for a company that's not even started. Like, it's crazy. So don't do that. You really go basically find a company similar to yours, look at their terms and conditions. My guess is they're not going to be very different, and use those for now. And then as you go through and you actually start understanding them, then amend them. And once things pick up, because right now, like, terms and conditions should not be holding you back. Like, the actual business model and generating traction and revenue should be what you should be focusing on. So really just look at companies of your type and what theirs look like, because they don't really differ that much and they can't be specific at this particular point in time. But I have to check. I know that we had it in line, so let me I'll come back to you. Just email me and we can go through that.
Okay, thank you. Because I just wasn't sure if I can just copy their terms of conditions.
Aside from SeedLegals, yeah, you can. Like, nobody's really gonna check. As a SeedLegals rep, no, you can't. But at this stage, like, nobody checks. Does that make sense? Like, there's no liability there. Not possible. But drop me an email. I'll have a talk with our legal team and I'll come back to you with like a more concrete plan than that. But at the moment, like, if that's the one thing holding your website back, then
Thank you.
All right.
Awesome. Anybody else got any questions? If you want to quickly, Edgaris again. Okay, Edgaris. There we go.
Okay, so basically we have a question. How does it work transferring company between countries? So let's say I create a company in the UK based on LTD, and I would decide to change its country to limited corporation, let's say in Baltic states or maybe in Germany.
Yeah, it depends. Would you be creating a subsidiary in the UK and a parent company somewhere else, or just moving the whole company?
Moving the whole company mainly.
Yeah, well, with that, I don't really handle like multi-jurisdictional kind of companies filings. Like, every different company, like the UK is the easiest place to register or move a company to because it's the cheapest. In France, it's more expensive. In Germany, it's incredibly expensive. So it really depends. Again, like, it's not my area of expertise, but I do know that we know people that do that, because we have a lot of flips, especially to the US. So just drop me an email and I'll ask our legal team on that particular point, because they've done it. Like, we've advised on this, but it's not necessarily something I deal with day to day. But do drop me an email and I'll get back to you.
All right, thanks.
I will now just go to Mubasher. I think he's still here. He did just message me to say he's having, okay, I think he's watching on YouTube. So let me just, okay. So he's watching on YouTube. So he's not with us actually in the Zoom. So I'll ask the question for him. He said, on what are the common mistakes occurred in due diligence stage?
Really basic stuff, which I was going over. So, like, is there a founders agreement? Like, is your website, like, do you own the rights to it, right? Have you made, like, are your company's house filings right? So when you incorporate on company's house, right, it's a really old, stupid system. Every time you allocate shares to somebody else, like, have you submitted those forms? Were they submitted correctly? Like, you have no idea how many rounds we get to where we get to the round and we realize we can't close the round because all their filings up to that point were completely wrong when you fill in those forms and send them in. And that's also why we automated them, so that wasn't an issue. Like, does your balance sheet make any sense? If you ask somebody turning revenue, like, does it add up? If it doesn't add up, then, you know, basic maths are wrong. You won't raise investment. Another thing is if you're a company that actually does have it in manufacturing or in pharmaceuticals, like, you know, med tech, like, do you have a patent? Again, with patents, I wouldn't really go into them unless you're sure that this is what you want to do. Like, if you're a SaaS company, don't patent stuff. It's pointless. Like, it changes so quickly that, like, the patent you got 5 years ago won't make sense now. But if you're in something that a little bit more specific, that's in product or pharmaceuticals, like, investors will ask about that. Let me think. Those are kind of the big ones. Does it work is a huge one. People don't check, but when they do check and realize it doesn't, like, does it work? And then, yeah, the kind of basic stuff. And a big one will be looking at the cap table and what the share classes are like are there crazy voting rights like the head of WeWork had or stuff like that. So yeah, what's your burn rate? Also, big thing, traction. If you have 1,000 users over 4 years, and you're at like a 1% growth a year versus like a company that's been running for a year has 400 users but has a 20% growth rate, traction, like, they will invest in the company that has a 20% growth because it shows their ability to grow. So traction is a now thing, not we have this many users, and it's like, well, it's been 4 years, like, surely you have this many users. So that's a huge one. Traction is probably the number one that investors are looking like. So make sure you are giving them the right measurements there and showing like your prospect.
Awesome. And I think that is it. So I would firstly like to thank Isabella for taking us through a lot of stuff, answering some of your questions. So massive thank you. Obviously, you guys have got her email address, so feel free to get in touch with her. If you want to get in touch with us, just email us at hello@birminghaменterprisecommunity.co.uk. Obviously, speaking of traction, as Isabella just was, tomorrow we have a session at 8 p.m. where we'll be looking at lean startup fundamentals. So really looking at the key principles of lean startup, something that every new founder, every entrepreneur needs to know. One of our mentors, Steve Dalton, all the way from the Gold Coast in Australia, will be delivering that. So please take a look at that and join us at 8 o'clock tomorrow night. Thank you.
Yeah. And also on our end, like, I couldn't necessarily answer everything just because I unfortunately don't know everything, but if I have, like, just email me. Also, vice versa with any of our webinars, if you think they'll help, I'll send you recordings or whatever helps. I will probably tune into your webinar tomorrow. So,
awesome. Yeah. That sounds really cool.
Lovely stuff, guys. Thank you. Have a good
day. Thank you very much, everybody, and we will see you all tomorrow. Thank you.